I generally feel around this time of year between Valentine's Day and April 15th is a good time to have a conversation about gifts and taxes. Gifts, which hopefully were exchanged on Valentine's Day, when given during the marriage between spouses, they are considered marital property and therefore subject to distribution at the time of a divorce. A gift from a third party, however, to one spouse is separate property and the party keeps it. So the running joke, the irony is that if you have a gift from your spouse, you have to divide it up at the time of divorce. But the gift that you get from your boyfriend or girlfriend, you can get to keep. All jokes aside, and irony aside, there are important, serious economic, financial considerations about this theory. And so what we're talking about is a gift made from a third party. If that spouse is able to keep that gift separate throughout the marriage, then at the time of divorce, not only is the gift, but also the appreciation, that will be separate property, not subject to distribution. And now when we think about gifts, we usually think about rings or bracelets or watches, but it applies to all gifts. Real estate, transfers of interest in property, trusts, stock options, bonds. All of these are gifts. And so the consequences are greater because we're talking about gifts of greater value. What happens if a spouse during the divorce says, well, that gift from a third party was to the parties, to the marriage, not just to one individual? Well, then the courts will get involved. And when they do, they may look to the donor, the one who made the gift, because under the law, the donor has to file a gift tax return. And in there could be important information as to the value of the gift and, more importantly, who the gift was made to. And it's not uncommon for courts to look at tax returns. In fact, they frequently look at tax returns to find out what are the real income of the parties, their assets, and who's really telling the truth. Now let's talk a little bit about taxes. The question that I get asked most often is when the parties divide up the marital estate, is that a taxable event? And the answer generally is no. So for example, if there's a house that's worth $600,000 and the husband is going to buy out the wife and give her $300,000, that event is not taxable. So what about child support? Same theory, not taxable. How about maintenance, or what was formerly known as alimony? Well, that used to be a taxable event. The payor used to be able to deduct it, and the payee would have to pay income tax on it. But that is no longer the case under the current law. It is not a taxable event. So, I said earlier, generally the answer is no as to taxes, but there are important considerations that people should understand when we're talking about this. One is that on a marital home, there are two exemptions that our parties are entitled to. Each party gets a $250,000 exemption. So the first $500,000 of gain on the principal residence is not taxable. Okay, but what happens if the gain is more than $500,000? Well, then the party that's buying out the other party, they need to consider that because when they sell the property, they'll have a tax consequence, and that should be factored into what the other spouse is getting. What happens with this 250 exemption if one party trades off their interest in the house? They sign a deed. Now the party retaining the house has the principal residence only in their name. Will they be able to get the $500,000 exemption? They need to consider that. And thirdly, this exemption issue only applies to principal residences. It does not apply to other parcels of real estate. For example, the second family, the vacation home, the family house that they purchased, the commercial property. It does not apply there. When those properties get sold, they are subject to capital gains tax. And so if the parties are going to divide up the amount of the value of those assets, they need to consider the tax consequences to divide it fairly. Couple of issues that also come up with this is, one is dividing up other assets to make sure that we have a fair division. And so when we're talking about real estate, let's say we have two pieces of property, both worth $600,000, both with a $300,000 mortgage on it. And the parties say the wife gets one and the husband gets the other. Is that fair? Well, maybe, and maybe not. Why? Because you have to factor in what the cost of that property was. So for example, if the wife is getting the property A, and it's worth $600,000, but she paid $100,000 for it, or the parties did $100,000 for it, then it's gained $500,000, and there'll be a significant tax when she sells it. If the husband retains the property and it has $600,000 of value on it, but they purchased it for $500,000, then the tax is going to be much, much less. And that has to be considered between the parties when they're trading off. One last point, and we hear this all the time. My spouse is really making a lot more with the business than he's declaring. That business is worth a lot of money. There is a lot of income generating. He's not declaring it. What will the courts do then? Well, yeah, they'll look at to see what the lifestyle has been, what the expenditures have been, but they'll also ask an important question. How were the taxes filed during the marriage? Were they jointly filed? Was it a joint tax return? If it was, then the court is going to say, well, you're making that complaint now about income, but all those years you were attesting to the fact that the business was making less, and that could be held against you. And so we don't often think about how we're going to file taxes when the marriage is going well, but it is an important factor to be considered when the marriage ends in divorce.